Imagine how you would feel if you planned for retirement and right when you got ready to retire and start taking income from your retirement accounts, tax rates double. And now this retirement income that you worked so hard to create for your family, half of it is now being taken away from you and your family and now going to the government in the form of taxes. Now, I don't ask that question to startle you. I don't ask that question to imply that I know for a certainty the tax rates will double. I ask that question because part of the retirement planning process is knowing what are the things that put my retirement dreams at risk and how do I remove as much of the uncertainty as possible so that I can have peace of mind as I plan for retirement. So that's why we ask that question about taxes. So what do you think? Do you think taxes are going to be higher, lower, or the same 20, 30 years from now? Now, many economists and financial experts, they have been advocating for the past few years that tax rates have to go up. Some even saying that tax rates have to double. Why? Well, if we were to kind of boil it down to a simple answer, it would just be debt. The United States is in a tremendous amount of debt. In fact, right now they owe more than $21 trillion in debt. That does not include unfunded liabilities that the government has to pay for, like Social Security, Medicare, Medicaid. It also doesn't include something that was given to many Americans this year, and that's the stimulus package. So when a person realizes the amount of debt the United States is in, they have to ask themselves the question, how will the United States pay for all of this debt? Well, they have three options. They can stop spending money, they can create more revenue, or they can raise taxes. Now, which one do you think is probably the easiest for the government to do? Right? Raise taxes. So how do we address this issue? Well, we address this issue by looking for tax-free strategies. For example, what you see on the screen are the three ways that our money can be taxed as we prepare for retirement. So we could have our money growing in taxable investments, taxable buckets. These are like savings accounts, CDs, some stocks can be taxable. This bucket, the money that grows inside of it is taxed every single year. Or we can have our money growing in tax deferred accounts. These are accounts where we basically say we don't want to pay taxes on this money now, but we'll defer the taxes and we'll pay taxes later when we're in retirement. These are accounts that are at risk because if tax rates go up, we could end up paying taxes at a higher rate than we thought when we opened up that account. Accounts that fall into the tax deferred bucket would be 401ks, 403bs, traditional IRAs, and even pensions for teachers are going to be taxed at whatever the income tax rate is when they enter retirement. And then the final bucket where we can divert some of our money is this tax-free bucket. Right? This is the bucket where we basically pay taxes on the money when we put it in, just like the taxes come out of our check now. And all of that money grows inside of our account completely tax-free. Now, the accounts that allow us to do that are some municipal bonds. They have the potential to be tax-free. Roth IRAs and Roth 401ks are tax-free. With Roth 401ks, at least the portion that you put in is such. The employer match, if it's there, won't be tax-free. And then life insurance has the ability to be tax-free. If it's properly structured and the majority of your money is placed inside of that vehicle for growth, then you can take distributions from your life insurance policy completely tax-free in retirement. And so where do you think the majority of teachers have the most of their money? Yeah, it's in tax deferred retirement accounts. The pension is automatically there. So let me see if I can paint the picture for you clearly. So if I'm saving for retirement and I believe taxes are going to go up, there's nothing I can do about my pension. My pension is going to be taxed at those future tax rates. But if I'm also deferring taxes on 403bs or other tax deferred accounts, I could be making my problem worse. What's the point of this entire conversation, this discussion? Well, it's quite simple. If my pension is automatically going to be tax deferred, and I know that taxes are going to go up, then it would make sense to now take this money that I'm trying to save for retirement and divert it to a position where it would be tax-free. So that really, no matter what the government does with taxes, no matter how far they go up or whatever changes, that won't have an effect on me and my retirement. I'm Jason Kennedy. For more information on retirement strategies or to set an appointment with me one-on-one, feel free to click on the link in the description below.